Hello everyone, welcome to my accounting tutorial video. In this tutorial video, I will be teaching you really basic accounting, bookkeeping, and particularly posting transactions to the general journal. Now, for this tutorial video, I made up some fictional transactions with fictional amounts and dates for a fictional company called Matt's Accounting Services, and this is a general journal template that I prepared. And for now, ignore this reference column. We will come back to it later in the second step of our tutorial. Before moving on to posting these transactions to our general journal, I want to talk about T accounts. T accounts are charts that list all transactions, and you need to post each journal entry to their relevant T account, which will allow you to find the final balance of that particular account at the end of the accounting cycle. We have 5 types of accounts. As you see from the chart, assets increase on DR, which is debit, and decrease on CR, which is credit. Liabilities decrease on debit and increase on credit. Owner's equity decrease on debit and increase on credit. Revenue decrease on debit, increase on credit. And expenses increase on debit and decrease on credit. You have to memorize this relationship between debit and credit for each type of account. It is crucial to whatever you do in your accounting practices. There's also an important formula that you see here. This is called the accounting formula that you will need when you're preparing the balance sheet. Basically says assets is equal to liabilities and owner's equity. You have to remember this formula at all times as well. Now let's move on to our journal entries. Our first entry is investment of $200,000 to start the business. This entry takes place on January 2nd. So if you go back to our general journal account, general journal template, we have January 2nd as our date. And let me just extend this a little. And we are investing $200,000 in cash. So we have an increase to cash, an asset of 200,000, and decrease to an equity account. And we can name the equity account as Matt Capital, since the owner of the company is Matt. So credit to that, and then the amount will be $200,000 for each. Notice that we always indent credit entry when we're making journal entries, so the amount of credit is always indented towards the right. Our second journal entry, if we go back to our list, is pay $200 for electricity and water on February 24th. So we have February 24th as our date. And we can categorize electricity, water, heating, etc. as utilities expense under one title. So we debit to utilities expense, which shows an increase in expenses, and credit cash in the amount of 200. Our third entry is March 2nd, provided services of $25,000 for cash. Now, the first thing we do, debit to cash by $25,000, is obvious. And in exchange for that, we have to credit something in order to increase another account by $25,000. Since we're providing services, we credit a revenue account, which is sales, by $25,000. Our fourth entry bought office furniture and equipment for $5,000 on March 9th. So the date is March 9th, and then we can debit office equipment or furniture and equipment and credit cash since we are paying cash, and then our amount is $5,000. Next entry is March 30th, provided services worth $1,250 on account. So that's our date, March 30th. Now, on account means we provide a service, but we do not collect cash right away. We will collect the cash in the future. And we have a special asset account called accounts receivable for this transaction. So we debit accounts receivable by $1,250 and in exchange credit sales by $1,250. In other words, we recognize the revenue, but we do not collect cash just yet. Our next transaction is paid $500 to repair broken equipment on April 8th. So April 8th is our date, and then since we're making a payment, it can be classified as an expense. And since we are fixing the equipment, we can start a new account called repairs expense and credit cash by $500. Our next transaction takes place on May 1st, and we purchased office supplies for $200. Now, supplies is something that is used for short term. So once we purchase the supplies, it becomes an asset. It's not an expense yet. We will talk about expensing the supplies shortly. And the account that we have to record this transaction in is called prepaid supplies. Don't get confused by the word prepaid. Prepaid is a type of an asset, a short-term or current asset. And in exchange, we are paying cash, so that's credit to cash by $200. Our next transaction is May 31st, provided services worth $2,265 on account. So May 31st, and this transaction is very similar to the one we recorded on March 30th. So our date is May 31st, and we debit accounts receivable and credit sales by $2,265. Now, next transaction is on June 5th. We are paying a monthly salary to an employee of $1,000, and that's June 5th. This is another type of expense. We can name it as salaries expense. So that's a debit increase to salaries expense and credit to cash by the amount of $1,000. Next transaction is July 31st. We are providing services for $2,000 for cash, and this is similar to the transaction that we saw on March 2nd. So going back to our journal, we put the date, debit to cash, and and credit to sales by $2,000. Our next entry collected $5,000 for services to be provided next month. The key term here is next month. So what's happening here is on August 3rd, we are collecting cash, but we haven't provided the service yet. This means we have a special liability account called unearned revenue. The reason why it's unearned is because we are collecting it, but we haven't earned it yet, meaning we haven't provided the services that refer to the cash we collected. So we debit to cash, which represent increase by the amount of $5,000, and credit unearned revenue. And again, don't get confused by the term revenue here. Unearned revenue is a liability account. We credited it by $5,000. Our next transaction, August 7th, is collected cash for services provided on account on March 30th. From the general journal, we can go back to March 30th, and we saw that we have $1,250 of balance outstanding, which we are now collecting. So on August 7th, we debit cash by $1,250 and credit accounts receivable by $1,250. So one asset account is increasing, the other is decreasing. So it is still balancing out. Our next transaction occurs on September 26th. Provided services that was paid for last month. So if we go back to last month, we have an unearned revenue from August 3rd. And we already collected the cash, and we are now eligible to recognize the sale because we just provided the services. So on September 26th, we debit unearned revenue, which is a decrease in liability, and credit sales, which is revenue. And the amount was from August 3rd, it was $5,000. Our second last transaction, happening October 4th, is collecting cash for services provided on account on May 31st. And on May 31st, we provided a service for $2,265, and now we're collecting cash for that. So we put the date, increase or debit to cash, and then credit or decrease to accounts receivable by $2,265. Our last transaction is happening on October 31st. The owner withdrew $400 from the company. Withdrawal account is another equity account, and it increases on debit. It gets treated like an expense. So we can name the account as MAT withdrawals and credit cash, since we are decreasing the amount of cash in the company by $400,000. Now, are we done? Not yet. We have two more things to account for. These are the year-end adjusting entries that we have to prepare at the end of the year. And assuming that the business cycle, which is also known as the fiscal year, ends on December 31st, we have to make two entries on December 31st. So our first entry is, by the end of the year, there was $75 of supplies left. If we go back on our transaction list, we had originally purchased $200 of office supplies, but we only have $75 supplies left now. So we have used up $125 worth of supply. We debit now supplies expense and credit prepaid supplies, which is an asset account. by the amount of 125. And our second adjusting entry that we have to do on December 31st is depreciation expense for furniture and equipment was $250. Depreciation is a contra account against capital assets. Each year, the balance of capital assets is revalued by calculating how much the capital assets gets devalued. For now, we are assuming that $250,000 is a given, but there are special ways to calculate it, which is beyond the scope of this particular tutorial video. So we will come back to it next week. And let's go back to our general journal. The first thing we have to do is debit depreciation expense, furniture and equipment by $250, and credit goes to a contra account against the capital asset, which is furniture and equipment, called accumulated depreciation by $250,000. And this is the end of the general journal for this year. We have prepared all these entries, and now next step will be to post these entries, each of these entries, to our T accounts, which is also called general ledger. And then when we're doing that, we will come back to the reference column. So thank you for watching my tutorial video. I will see you later.